thinking about moving your business to a state with no income tax? Well, here to talk with me about this is Philip Herzberg from Team Hewins. Philip, welcome.
It's great to be speaking with you on this important topic, Bob. Thank you for having me.
It's always a pleasure to chat with you, Philip. You always write about such great topics, and this one is particularly intriguing because I think many business owners are thinking about this question. So, walk us through what folks need to know.
Yes, certainly stepping away from your business, it can be an emotional time period and as well as a pivotal transitional period, especially if you've dedicated most of your life to your company. The ultimate payoff for most successful, long-established business owners, the ability to transfer ownership of the company to their children or to sell the business and achieve their financial goals. And just relocating to a new state adds a twist. And it's very important. You'll need to fully grasp the tax laws of both the state where your business is located, as well as the new state, because otherwise you may be overlooking key considerations related to the structure of the sale and the timing of the move. And oftentimes you may be focused on figuring out what is an acceptable price, yet a more significant issue is how much you will keep from the sale. And the most important variable is how taxes will impact that transaction.
Right. So, what do folks need to consider when moving to a new state?
Well, there are three top of mind considerations when moving to a new state. First, the state exit taxes. Second is applying federal and or state income taxes to the sale. And third and final is the timing of the move date and the business sale.
Right. So let's drill down on all these topics. The first one is the exit taxes.
Yeah, the state exit taxes. And without the proper planning there, including the knowledge of states with exit tax, you may be susceptible to mishandling the sale transaction from a tax perspective. So state exit tax is a one-time tax that may be paid by residents owning businesses, or primary homes who move their legal residence from a high income tax state to a low or no tax state. When contemplating selling your business, first thing you need to assess which states have an exit tax. New Jersey and California, for instance, which have very high state income taxes, are among the states that may levy this exit tax currently or in the future. In New Jersey, the exit tax is actually a withholding or estimated tax that is paid in advance if you sell the real property, such as a primary home, and are moving out of state. And in California, for example, legislation has proposed to annually tax the wealthiest residents for up to 10 years after leaving the state, which is part of the state's wider tax on wealthy people.
That's quite a tax. What about the federal and state income taxes that are applicable?
Well, taking a look here at the federal capital gains tax, sale of a business often triggers long-term federal capital gains taxes for the seller. So for example, in using round figures here, if you invested $500,000 when starting a business 15 years ago and you sell it today for $10 million, your long-term capital gain, you realized, is $9.5 million, which is calculated by subtracting the selling price from the original cost basis. A federal capital gains tax of 20% as well as the 3.8% net investment income surtax would apply, which would reduce the possible net proceeds from the sale to below $8 million. Also, a crucial consideration is the state income tax. And for instance, California residents on the same transaction here, you invested $500,000 when starting a business, sell it today for $10 million. So looking at the state tax in addition to the federal tax, state income tax, top state income tax in California is 13.3% on the same long-term capital gains. So using the example here with a capital gain, federal capital gain of 9.5 million, the net proceeds to the seller after federal and state income tax would be about $6 million. So some states such as Florida and Texas do not have a state income tax. So conducting your sales transaction while residing in those states have an obvious advantage to the seller.
Right. And what about the timing of the move date and the business sale? Tell us more about that.
Very important. Timing is also a critical consideration here. So if you plan on selling your business in close time proximity to when you locate, this major transaction may work against your claim that you changed residences if you are audited. So the bottom line here is that you should be a resident of a no income tax state before you proceed to sell your business. So determining your domicile or your actual primary residence is a question informed or grounded by your intent here. So auditors look at concrete evidence such as a significant income transaction immediately after a claim break in domicile, figure out the actual intent as a seller. Just be mindful here that states have access to a plethora of information about you, such as your bank accounts, voting information, car registration. All these pieces of information can be utilized as evidence as to whether and when you actually intended to permanently move from one state to another. So the state is more likely to trigger a residency audit to the tax year surrounding the business sale transaction if there is a large income tax transaction immediately after you assert that you changed residency.
Mm. What about a couple other things, Philip, about installment sale rules? Do folks need to become acquainted with those rules?
Yeah, if you have plans to relocate, you may think of setting up the sale of a business so the seller receives payments over time instead of maybe as a single cash transaction completed while you're in your former state of residency. So an installment sale, will save you on income taxes under the tax laws of the new state. And even though this is how the situation works for federal taxes, states do not automatically follow this installment tax treatment of deferring state tax payments until you receive the check, until you receive the cash proceeds. So when you move out of the state and accordingly stop filing taxes there, the former state, the state that you're leaving from, will sometimes accelerate that recognition of that income, even if you haven't received the cash yet under the installment plan terms. So these states would let you defer tax payment if you stayed in the state, but not if you stop filing after you leave. Best approach here is to file a form in your previous state promising to continue to file tax returns in that state for as long as you're receiving payments under the installment note. And even though you have not received the installment cash yet, you would be obligated to pay the tax in full in advance if you don't continue filing there. So just be wary of whether the state where you are selling your business recognizes deferral treatment when you move out of the state. You want to avoid a situation where you decided to move to a specific no income tax state when you sold your business, since you assumed you would not owe taxes to your former state under the deferred payment agreement terms. And this understanding may actually impact your decision to relocate, the timing of the move, or your utilization of this installment sale technique.
Mm. And what about selling a partnership interest? What do folks need to know about that?
You need to know basically, whether this is an intangible property that you're selling or a tangible property. So if you're moving from a state with a high income taxes to a no income tax state, and then you're selling an intangible property like a license or a copyright, the source of the gain for state individual income tax purposes is the state you reside in at the time of your sale. In contrast, if tangible properties such as land or buildings were sold, the gains on the sale are sourced to the places of the property, to where the property is located at the time of the sale. So a possible caveat here is again with partnership interests. Some states consider them to be intangible sales, in effect moving from a high income tax state to a state with no income tax, and subsequent selling the partnership interest would result in no state personal income taxation of the resulting gains. Other states, though, that tax on income have a different view towards sourcing in relation to the partnership sales, and they take what's called a look-through approach to sourcing the resulting gain. So consequently, these states would tax you on a portion of your gain from selling an interest in a partnership that operated there, even if you sold your interest after you moved away. Best guidance here is to consult with a qualified tax advisor who is well versed with the laws in the state where the partnership operated and where the seller lives, to help you tackle any possible complexities.
Yeah. Philip, we ran through a lot, but it was really helpful, and I really appreciate you sharing your knowledge and wisdom with our readers and our viewers, as always. Thank you.
You're welcome. Just some final takeaways wanted to add here. So before preparing to sell your business and possibly leaving the states that has been your historical domicile, be sure to speak with specialists that can help you understand important financial tax implications, and that includes state and local tax ramifications. Certified financial planners or CFPs who work in tandem with qualified tax practitioners can empower you to set up a plan that maximizes your financial benefits and minimizes income tax consequences, while enabling you to relocate to a desirable state with no income tax so you can begin your next chapter of life with confidence and peace of mind.